All right, everyone, the US markets are facing a storm that most people aren't talking about. Yesterday, trading screens across the country were flashing red. Losses piled up fast and panic is quietly spreading. The S&P 500 took a sharp dive, falling more than 2% in one of the worst days since 2025. Overall, US markets lost over $1.2 trillion in value. Tech stocks were hit hard, but even the banking sector didn't escape. JP Morgan dropped more than 3%. This isn't just a random market wobble. There's a deeper signal here. If January closes in the red, history suggests the rest of the year could follow the same downward path. Investors are nervous, and rightfully so. The global confidence in US assets is being tested. A key factor is foreign capital. For years, the US has depended on countries like China, Japan, and Europe to recycle their dollars back into US bonds. This kept interest rates low and fueled growth, but that system is under pressure. China has been steadily selling its US Treasury holdings, and Japan's bond market is now under stress. Europe has been the stabilizer, buying US debt consistently. The UK increased holdings by $148 billion last year, and France added $41 billion. Without Europe's support, the US financial system would feel even more exposed. The problem, political decisions are complicating this delicate balance. Aggressive moves against allies, trade tensions, and military spending ambitions are putting pressure on countries that hold US debt. Scott Bessent, the Treasury official, has been warning allies to stay calm and not react aggressively. The US needs their cooperation more than ever. The reliance on deficit spending is massive. Between military expansion, global interventions, and domestic obligations, the US government depends heavily on foreign funding. Europe's bond buying has been a crucial lifeline, countering China's sell-off. But now there's a growing risk. If Europe is forced to spend more on defense and internal programs, they might start selling treasuries. Even small moves can create ripple effects. The Danish pension fund recently offloaded some US debt, tiny in size, but enough to make markets reconsider. The consequences are clear: rising yields, higher borrowing costs, and slowing economic growth. About 70% of the US economy depends on consumption, which could shrink as credit costs rise. Companies face higher borrowing expenses, hiring slows, and job growth struggles. The job market already shows strain. There are fewer jobs than seekers, and unemployment is climbing. Consumption is weak, and businesses are hesitant to expand. If treasuries continue to be dumped, these trends could accelerate. Japan is another concern. The prime minister called a snap election, and Japanese bonds are under pressure. Yields on long-term bonds spiked sharply, reflecting a loss of investor confidence. Japan holds over $1.2 trillion in US treasuries, and if they start selling to support the yen, it could trigger a global cascade. Even with Bank of Japan interventions, the yen has dropped over 30%, and bond yields continue to climb. Japan's moves aren't just about domestic policy. They have direct consequences for US assets. This interconnected risk is why Treasury officials are sounding alarms. Europe, Japan, and China are all watching each other, and even minor actions can escalate into major market shifts. Historical patterns show that selling pressure from one major holder often triggers a chain reaction globally. The stakes are high. Rising yields threaten spending, slow growth, and destabilize the job market. Companies face tighter credit, households feel the squeeze, and confidence in the dollar could waver. Even political maneuvers that seem unrelated, like discussions over Greenland or tariffs, play into the market psychology. Investors weigh the cost of funding US policies against potential risks. If confidence falters, treasuries, long seen as safe, may no longer be treated that way. We are witnessing a fragile moment where US reliance on allies meets the reality of global economic pressures. Bessent's warnings highlight the importance of restraint. Escalations could provoke a sell-off that would ripple through stocks, bonds, and currencies worldwide. The potential domino effect is worrying. China continues to sell, Europe may be forced to prioritize domestic spending, and Japan could act to stabilize its currency. Each step increases uncertainty and risk for the US markets. At the heart of this is a simple truth: the dollar's dominance depends on global trust. If allies begin to doubt the stability of US assets, that trust erodes. We could see a long-term shift in the way capital flows globally, favoring BRICS nations and alternative economic alliances. Investors should pay attention to bond yields, international policies, and trade relations. The signals coming from Europe and Japan are early warnings. Action or inaction by the US can tip the scales, for better or worse. This isn't just speculation. Historical patterns show that when major holders of US debt act, markets react immediately. The potential for cascading effects on consumption, lending, and the job market is very real. The next few months will be critical. If allies continue buying, markets may stabilize, but any significant sell-off could shake confidence worldwide, affecting the US economy and financial system. In conclusion, US markets are at a crossroads. Political ambitions, international pressures, and global economic realities are colliding. Investors, policymakers, and everyday Americans alike need to watch these developments closely. The era of unquestioned reliance on US Treasuries is under strain. Global confidence is fragile, and even small moves could create outsized consequences. Positioning, vigilance, and strategic awareness will be key in navigating these turbulent times. The big question remains: will Europe, Japan, and other major holders maintain their support, or is a broader sell-off imminent? Only time will tell, but the warning signs are clear. Stay alert, stay informed, and understand that this isn't just about numbers. It's about global trust, market psychology, and the intricate web of international finance that sustains the US economy.